All right, welcome everyone to episode number 8 of the Wide Lens podcast. I am joined here remotely with my colleague Matthew Rigby.
On location from 2020.
And we're going to be covering the hottest and latest topics in financial markets and financial investment markets. Matt has a COVID kid, so he is in isolation. So I've got a couple of screens here that I'm going to be looking at, so it's going to look a little bit weird, but that's what's going on. But we're mic'd up, we're equipped up, so we're ready to go, and let's get straight into it with Matt's Market Minute.
All right, plenty of action over the last week or so in markets. So the Aussie ASX 300 up around 1.6 for the week, down 4.6 for the year, which is honestly quite a good performance. The rural sector has done quite well. So Australian Agricultural Company, it's flat for the week, but up about 10% for the year. Elders up 11 for the week and 8 for the year. New Farm 4.5, up 20% for the year. It's done exceptionally well. And GrainCorp, which was probably, that was the reason I selected this group, and it's the worst performer of all of them, up just 0.3 for the week and 0.6, down 0.6 for the year. I figured with everything going on in Russia and the Ukraine, wheat prices spiking would have helped them. The market doesn't think that that's going to be an issue. And I think it's a bumper wheat crop production year this year as well. So it should be plenty of exports. In the NASDAQ, up 1.5% for the week, down 14 for the year. So relative to the Aussie, underperforming enormously. Apple flat, JD. So some of the Chinese stocks, which we'll probably touch on later, but the Chinese stocks have done exceptionally well. JD's up 20% for the week, 39 for the year. 39 last night. Baidu was up 9 for the week, 39 last night. Alibaba up 36% last night. Some big moves there. Of the NASDAQ, 72 stocks are down more than 10%. So that's remained pretty steady.
Is that the NASDAQ 100?
NASDAQ 100, as it always is. So yeah, that's
I don't know why I don't know that.
That's been pretty stable the last, month or so. 15 stocks in positive territory. And, the Chinese stocks, as I just mentioned, mostly, moving towards positives. They're a bit mixed, but they've had a big night. So I'd expect.
Well, I think most of those names are down. And I think a lot of the ground has been made up from China's announcement last night or the night before about them changing their stance on internet stocks and whatnot, which saw those basket of stocks just go gangbusters.
Yeah, absolutely, and expectations they may have to start cutting rates there as well because the COVID lockdowns that they've implemented. S&P up about 2% for the week, down 8 for the year. EPAM, which is a tech software company, is up 44% for the week, but still down 56% for the year. United Airlines up 22%, American Airlines up 19%. So they've had a cracking one based on oil, which we'll get to in a minute. Year to date, 30% positive, 46% down, more than 10%. Emerging markets up 2% for the week, down 9% for year to date. So they've certainly come off, as we mentioned last week. Oil is the big one. So that's down 8.7%. It was down more than 10 at one point for over the last 5 days. Still up 27 or 28% for the year. But it's right back to where it was around the time Russia invaded the Ukraine. And the last one, everyone's favorite, everyone under the age of 30 anyway, Bitcoin's up 8.5%.
I'm not under 30, man.
No, you're not. Everyone under 40? Are you under 40? I don't know.
Yeah.
Anyway, up 8% for the week, down 14% for the year at about 41,000 US. And then we have it.
Interestingly, I filled up the car. So we've got a diesel and it cost me $135 the other day. And I went to pay.
What's that in Bitcoins?
You know what the guy said to me? He's like, "Oh, mate, I'll give you a bit of a discount." He took $1.25 off the price.
What sort of discount is that?
I'm like, is this guy joking? And I go, yeah, okay. He gave me $1.25 off. Has it ever happened to you? It's never happened to me in my life.
Not ever. That's
how pissed everybody is about this. The guy at the servo is giving discounts to people. there must be buffering these prices. It's ridiculous.
It has to be, right? Let's see how quickly they come down now that oil's dropped some 20% this week.
We'll get into that later, but that's ridiculous. So the thing that I wanted to talk about was with everything that's going on in the world right now, we have had one of the worst years on record for the stock market through to March. And so what I wanted to do, Bespoke had the numbers. So I just want to bring this chart up here. The 10 worst starts for the S&P 500. And so you see 2022 in the middle there, 1, 2, 3, 4, fifth down. So it's middle of the ground there. In 2009, we saw March, up until March, down 16%. The rest of March, and then you can see the first half of the year and then the rest of the year. And the interesting thing that I take out, I mean, obviously it's been a pretty rough beginning of the year. But if you then have a look at the rest of March, the corresponding rest of March, the rest of the first half of the year, and then probably more importantly, the rest of the year, there are only 2 instances in this table here whereby we're worse off than when we were. I mean, 2001, I'm just going to call that flat down 2%. But 2008 was the absolute standout here. You're down almost 30%. That was a severe financial crisis, right?
Yeah.
So that's there. But if you want to look at the bottom numbers, as we always do here, is you look at the average and the median sitting at 16.5%. The average return has been close to 20%.
From this point, right? From the 15th of March. Yeah.
That's right.
Yeah, I mean,
that's right. That's
pretty much one-way
solid
traffic
jump, isn't it?
Yeah, it really is. I mean, and 2008 is, I mean, I want to say an exception. I hope it is. But yeah, I mean, that was exceptional circumstances.
And that's 2 out of 8, Matt. So that's an 80% chance and probability of positive return. And the average return's been about 20%.
Yeah, I take those odds any day.
Pretty good odds.
Yeah, and look, that keeps in line. I mean, we keep seeing these charts, and 75, 80% of the time, markets are up. From this point or whatever point we're looking at. So pretty consistent.
And the counterintuitive thing is and I don't know how profound this is, but I don't think that many people think about it this way. The longer and the more things go down, the probability of them rising increases. I mean, that's a very generic statement to make. Maybe that's not as relevant as it may be to a particular stock, whether it's a Netflix or whether it's a stock that's been clobbered, versus how true is that of the S&P 500 as an index. And I think it's far more truer for the S&P 500 as an index rather than individual stocks. So that's my point.
Yep. Yeah. Well, we'll see.
Let's jump to the elephant in the room, which is, now I don't know who got this right. The Federal Reserve over there the last couple of days, around a boardroom table, arguing, debating, maybe sinking beers. I don't know what they're doing. But in the end of it, interest rates are up 25 basis points. Yeah,
far cry from what do you remember? Was it Feb? Everyone was calling 75,
100 points.
I think it's just out of control. It was a competition who could justify the highest kickoff. I don't think anyone's probably overly surprised. A lot has changed since February, obviously. Inflation's continued to go up and it is likely to keep going up for some time. I think, I kind of almost hoped that they would have gone 50 points initially and then held off. But I think I did comment that the markets will be happy with like a bit of certainty, a bit of guidance. And that's certainly what they've done. I
think the market's happy that they actually did something. So Bloomberg, I'll just bring this article up on Bloomberg's article. Powell ramps up inflation fight in economy tough enough to cope. Acutely aware of need to restore price stability. Fed raises rates a quarter point and signals more hikes ahead. So I think they've indicated like 6 hikes for the rest of the year. Like, to me, I don't know how you can indicate something if we don't even know what the hell's going on between now and the rest of the year. I'll just quote this from Bloomberg. The Federal Reserve kicked off a tightening campaign that's set to be amongst the set to be the most aggressive in decades, as Chair Jerome Powell assured Americans the economy won't tip into recession, which is really interesting. We'll talk about that shortly.
Mm-hmm.
After raising interest rates by a quarter point and signaling 6 more increases this year. Signaling, okay. Powell told reporters that inflation is too high, the labor market is overheated, and price stability is a precondition for the US central bank as it tackles the hottest price pressures in 40 years. The most interesting thing I thought, though, was like almost in the same breath, we had this article come out from Bloomberg again. Stocks jump as upbeat Powell, China helps sentiment markets wrap. So Powell said US can handle tighter policy as Fed hikes rates. And S&P 500 rallied, but flatter yield curve signals growth concerns. And like my comments are like, what the hell is going on? So everyone's worried that the Fed was going to raise rates, right? And then the markets tank. So they raise rates, markets rise. Like, can you educate me here, Matt? Like, what is going on? What do you think is going on here?
I don't know if I'm that smart, mate. I think, yeah, as with everything, it's the anticipation and the uncertainty that kills markets, kills people. You know, they just don't know. You know, when you've got, I think Goldman Sachs, JP Morgan were coming out early in the year saying rates are going to go up by whatever, 75, 100 bips, 125. When it actually happens, and then Powell goes, you know, we're the dot plots signaling another rate rise for each of the 6 remaining meetings, I think they've said, or indicated. So I think that certainty, the market hates uncertainty. So now we can sort of price that in. Now we can kind of go, okay, well, here's the path based on expectations. The thing I found interesting is they upgraded their inflation expectations and downgraded their growth expectations. But Powell assured Americans that they weren't going into recession. So that's a interesting. That would seem to be kind of opposing that comment. Those moves.
The market. I mean, clearly the market has an uncanny way of being able to price things really quickly, and to try and front run that's a pretty tough gig. And so maybe all of this was priced in when we were going through all this shit in January.
Yeah,
like maybe that was pricing all of that in, and now things aren't as bad as what we thought, and so markets are coming up now, and maybe that's as simple as what it is.
Yeah, priced it in, and probably priced in more. So maybe there was a bunch of people out there expecting 50 bips today, not 25, and therefore it's a better result, and so we're rallying. But I think a lot of it is expectations. China certainly helped. I mean, that was a big move by the Chinese stocks, and continued. I don't know, progress, if you can call it that, with Ukraine and Russia, and potentially that ending. There seems to be some more positive language coming out that they are getting closer to meeting to some sort of agreement. So that, that's obviously going to be positive as well on inflation.
Yeah, but if all these things are positive, I don't know. At the end of the article, I love how it just, by the way, quote, in cryptocurrencies, Bitcoin joined in the risk asset rally and was trading around $41,000. I found that I had a bit of a chuckle when I saw that, like a by the way. Let's move on, because we're going to cover a lot more about rates and recessions.
Yeah, absolutely. And so this, so the next article, I guess, that I'd come across, and in the same vein, was again from Bloomberg, and we can just bring it up here. So Goldman Sachs sees US recession risk as high as 35%, cuts forecasts. So the analysts at Goldman Sachs have crunched the numbers, and they're saying that there's a 35% chance of a recession over the next 12 months, and that's, they've said, in line with what the bond market is sort of indicating. So a 1 in 3 chance, you might say. Again, the economists here have cut their prediction for expansion. So they're saying the US growth is going to be at 1.75% for the next 12 months, down from 2%. And I think the IMF had also come out and cut global growth expectations. So there's a whole lot of indicators to say, that the growth is slowing, inflation is biting, consumers haven't lost their jobs, and that's a great thing. But that's kind of the canary in the coal mine. I think if that unemployment rate starts to plateau, then there's some real risk that the Fed might go too far. And I think that's just generally what they're saying is rates are going up, inflation's going up, wages really aren't going up at that level. And even if they are, they've got to go up pretty significantly to stay ahead of the rate of inflation. And that's, there's certainly no indications of that happening. So, Goldman raising the flag there or increasing the risk of inflation, of recession.
Do you think investors are just constantly worrying about the next big thing? So no one was worried about inflation a year ago, and well, maybe not quite a year ago, but inflation was the thing. Then interest rates were the thing, and now recession's a thing. No one was talking about recession 6 months ago. And so I feel like it's like the next, whatever the next leg of the process is, or the cycle is. I feel like once we reach that and we tick that one, it's like, oh, inflation. So what inflation means is interest rates. Now let's all shit ourselves over interest rates, and then interest rates are sorted out. Tick. Now what's the next thing? And next thing is recession, and let's worry about the recession. Yeah. Like I mean, there's always something to worry about, right? Like I don't think there ever goes a day that we're not worried about something.
Yeah, no, you're absolutely right.
How helpful is that?
No, it's not helpful at all. Just sit back and enjoy the gains, or enjoy the ride. But
I think if you're invested,
it's human nature, right? I mean, do you think it comes down to people going, all right, I'm going to try and beat the next downturn? So we've had this. All right, I'm going to try and get out now before we have a downturn, and avoid those losses. I mean, I don't know if that's what people are thinking, but
we don't have the numbers here, but I don't know if we've ever had like a recession and stocks have gone down. I mean, the last thing I could think about was COVID, but it didn't last long at all. But couldn't it be at all possible that we just have a mild recession where the bottom just doesn't fall out of the economy, and we don't have an 80% decline in stocks and an unemployment rate of 30%? Like, I mean, unemployment during COVID was supposed to go to 20%. Remember that?
Yeah.
Remember all these predictions that came out, and then we had the cavalry coming in and stopping the bleeding. Like, can't we just have a little recession and then we get that out of our system and move on? Like, is that not possible?
That's what 2020 was, right? A little recession. I think, but I think that, to kind of what we said before, is the extrapolating current conditions and not factoring other things. So the COVID recession probably would have been that bad had the governments and central banks not stepped in to the enormous degree that they did.
You can't say that. You can't say it would have been this bad if they didn't do it.
Well, my point is that
but they did.
Things are so dynamic that you just don't know what it is that's going to come up next. So if we do go into a recession, you're right. It might be quite mild because I don't know, the Federal Reserve starts to unwind their rate rises, or Reserve Bank or the governments come in and come out with job keeper programs again, and that will help to mitigate it. If they don't, then I mean, nobody knows, but you could probably make an argument that if you just let it run, and it also depends on how far rates get to before that point. Let's say we tip into recession next quarter, there's not a lot there to cut.
Well, we can't do that because we've got to have 2 quarters of negative.
Well, okay. So by November.
Yeah. So all this over the next 12 months has to be over the next 12 months. We won't technically have the data to verify a recession until the end of the year anyway.
And you need to go a certain way so you can then unwind it all. What did you say last week? Central banks raise rates so they can cut them. So they need to get a certain way down the road before they can start cutting, because they can't start cutting from next to zero. I mean, what do you just expand balance sheets even further? So
let's bring this chart up. Let's bring this US CPI and recession chart. Do you want to run through this?
Yeah. So just an overview. So this is going back to, where are we? 1950-ish, somewhere there. And each time inflation has spiked above 5%, and there are some fairly significant spikes there. You can see in the 50s. What's that? Mid 70s, and of course the 80s. There's
90s,
fairly consistently. There's a recession not too far away. So we can see in 1950, I'm going to say that's 1958. I can see in the 70, 75, 80, 90, 2000. So every time it's dipped above, and maybe that's central banks being overzealous and raising rates too far too fast. Maybe, there's a whole bunch of reasons that it could be, but rates are a fairly consistent theme throughout this. And rates are the blunt instrument that central banks and governments use to tackle inflation. And I think, we've kind of said that there is a risk, and the markets have said that there's a risk that the Fed and reserve banks and central banks around the world are too far behind the curve. And that is they've been a bit too slow in moving. And now they've got to move a lot quicker to catch up to tame this. And the risk is you go too hard, too fast, and you tip the economy into recession. So look, it's interesting. I don't know. We'll know in hindsight as to whether this one turns out or results in another recession. But I think the risk is there, and unemployment is super strong. So super strong and declining at a pretty rapid rate. So I think that's something, as I mentioned earlier, that to keep an eye on. But, I think the risks are low this year. That's for sure.
And I think to your point, I think this would actually be a recession with the strongest employment that we've ever had. And so if you look at employment, numbers just start, obviously getting really bad. This would be the lowest record of unemployment under a recession that we've ever had. So I think that's the counterbalance. Yes, we have this inflation. I want to. Do you want to talk about anything else on this chart?
No, I think that's probably enough. Probably the only other thing just to note is wages. Wages will have to start to increasing if this inflation gets embedded into people's expectations, and maybe that's the trigger for unemployment to start to move up.
So just on that, I'm still of the view that the inflation is. Let me just go through this and hope this puts it into context. Barry Ritholtz wrote this piece last week. He titled it "Normalization versus Inflation." Bear with me. I'm just going to read this. When we consider what were the key drivers of inflation before the war began, we see mostly one-off issues related to the pandemic. Huge fiscal stimulus via the CARES Act, consumer behavior during lockdown, the release of pent-up demand upon reopening. Before Russia's invasion of Ukraine, inflation was rising, and most of the aspects of the price increases were due to factors beyond the Fed's interest rates. Sudden increase in demand for goods over services caused by lockdowns, supply chain logistical issues, too few cargo ships, not enough physical shipping containers, not enough dock workers for major ports, too few truck drivers, massive fiscal stimulus. He goes on to say, now we have a war raging. Crude oil, natural gas, and energy supplies have surged. Nickels and other metals have skyrocketed. Are any of these responsive to Fed rates in the present environment? I think he has just nailed it. I don't think anything has to do with Fed rates. Yeah. Because I think all of these things would continue to prevail.
Yeah,
much of it. Even if the Fed raised rates by 50 basis points, or 100 basis points, or the oil is going to be the oil and people are going to pay what the oil price is, unless they get discounts from the BP guy down off Eastlink. Go there for everyone. but how do Fed rates impact anything that we've just talked, anything that Barry just outlined here?
Yeah, I mean, maybe the counter is, reduction in demand. So that's the whole reason central banks raise rates is so your mortgage costs more. You can only borrow a certain amount, or your repayments become more, so you cut spending elsewhere. And it doesn't affect supply chains, but maybe what it does is reduce the demand of those goods that are actually getting onshore, reducing the need for future supply to be ordered. That's about the only way. Most of it is absolutely out of their control, especially when you throw in the war and everything that's happening with Russia and the Ukraine and oil and gas and wheat and all these other things, which are all feeders into price increases down the road, they are all components for so many goods that we consume every day. So,
do you think, Matt, that if we didn't have, to your hypothetical examples you were giving before, let me throw one at you. If we didn't have the pandemic or the war, I mean, you're going to say, but we did. But if we didn't, would inflation be where it is right now?
Mm-hmm. Probably not. I mean, inflation's it's blamed on two things, right? The supply chain issues, which are a result of COVID, and the massive amount of money printing, reduced rates, all the rest of it that was a factor of COVID. So I'm going to say probably not. And we'd probably still be in this position where the Federal Reserves and central banks around the world were wondering how to get inflation up. Remember that was the big issue
100%.
2-3 years ago. I mean, how do we get inflation back to where it needs to be? So I guess the question is, as we've asked before, once we get through these supply chains, which maybe is a longer period now, China's going through their zero COVID pursuit. But once we get through that,
and semiconductors are taking even longer now because of all the issues that are going on in and around Europe and all the sanctions and restrictions. Now chips are struggling again.
Struggling to produce and export them.
Yeah, that's right.
Yeah, so maybe I don't know. My point was going to be, once we get through this, will inflation just come back down? Because there is no, once you remove all that stimulus and those supply issues that are the cause or drivers of this inflation, doesn't matter what Feds are doing. Does inflation come back down to normalized levels? That seems to be the Fed's expectation. I think they came out and said in 12 months' time, we think the inflation's back down to 2 to 3%. I'll have to check that, but I'm sure Powell came out and said he expects inflation to fall, and they were some of the reasons why.
Look, interest rates are really low. We've talked about this before. We've said we're going from free money to cheap money. I still believe that, and I think if you don't raise rates now, you've got nothing to cut on, down the track. So, raising rates 25, before you know it, you're at 1%. Like the 10-year bond, 10-year treasuries have already priced that in, and now we're just sitting at a flat yield curve. So time will tell. Let's move on because there's a little bit more to cover on this topic.
Yeah. So what's next? What does all this mean? Fed's raising rates. So this chart came from Jim Reed at Deutsche Bank, and we'll just bring it up now. So what it's basically saying is, so every Fed hiking cycle in the last 70 years, ordered by length of time from the first hike to recession. So you can see here where are we? So the number of months. So we've got August 1980, December 1980. That was a 4-month period where they were raising rates. The starting point was 9.5. The end point or terminal point was, where do they end? I don't know, but total hikes were 10.5%. So this is obviously during that hyperinflation period. And the hike in year one, which this was the most interesting for me, 6%. I mean, here we are worried about 0.25%, but 6%.
What are we mucking around with? Just bang.
just go hard, man. So this is interesting because it's it's kind of putting it all in perspective. So where are we starting from this time around? And you can see right at the bottom there, March 2022, we're starting at 0.08. The hike in year one, that's their expectation of 2%. Start of the hikes. So the 2s to 10s. So this third column here is looking at the yield curve. So it's looking at the 2-year rate in the market and the 10-year rate in the market. Now, how steep that is kind of is an indication of expectations. And you'll often hear an inverted yield curve, which is a bit of the market's indicator, or can be an indicator. It's not 100% reliable, but it's reasonably consistent that if you get an inverted yield curve, that is the 2-year rate is higher than the 10-year rate, it can be an indicator of a recession, in the next, I think it's 6 months is the rule that they use. So at the moment, it's 29 basis points, which is quite small. So that's something that people are already starting to say, well, hang on, we could get an inversion of the 210 yield curve, and is a recession coming?
And we had that in 2020, but it wasn't that caused the recession. It was it was a pandemic.
Yeah, was it 2020 or 2019? I was trying to think about this, and maybe
it might have been the back end of 2019.
It might have been right in hindsight, but it had nothing to do with interest rates. Yeah, absolutely right.
The reason why you made an argument for something was not the reason why you got it right.
It's not important. You're right or wrong.
That's really important.
Yeah, absolutely. So, and so this second last column. Months after first hike before the recession. So 11 months was the earliest back in 1981, 86 months from 83 to 84, and recession in July 1990. So I guess the long and short of this is there's probably no real consistent trend. It's very much dependent on what's going on at the time. Rates are starting all over the place. I mean, you can see 1618 here starting at 0.37, 9.5 in 1980, like I mentioned. So it's all over the shop. But I guess the fear is, and to your point earlier, rates are going up. Now we're already talking about that next recession. I mean, it could be years away. Who knows?
Well, the average time until next recession, according to Deutsche Bank, is 37 months.
Yeah. So what's that?
So that's like, what's
3
that?
years?
18 months? What?
37 months. I don't know what. We have 12 months on Earth per year. So we're at 3 years. So that's the average. Like I said, who knows? But people are already starting to freak out about something that may not happen for several years.
And what we haven't got here is, what happened to the stock market during that. Maybe that's for a topic for another time. But I thought the chart that you had up next was interesting as well, Matt.
Yeah, it's just interesting just to kind of, again, put everything in perspective, have a look at what's happened along the way. So this one here, which we'll bring up now, is the Fed funds rate annotated with a financial crisis. So, going back to the 1970s and just a few things that were happening, the UK secondary banking crisis. I wasn't around back then, but doesn't look like it was fun. Black Monday, debt crises from Russia and Latin America, and the Asian crisis in 97, .com, so on and so forth. So I guess it just puts a little bit of color behind that graph and kind of what was going on at that point in time.
What I make out of this is that when the federal funds rate, or for, if you're listening, and as it relates to Australia, the RBA cash rate, when that peaks, the recession follows. And so, if we're saying we're going to have rate hikes for the rest of the year and maybe a little bit more until next year, maybe nothing's happening until at least 1 year away. We just talked about. But it seems to me as though until the rate hikes peak, nothing happens until subsequently.
And not even right away. I mean, there are peaks there where recessions that happen for some time after the fact. So again, it's not consistent. There's no kind of hard and fast rule, but I think you're right. Once that, and it peaks because a recession is coming most of the time, or we're in one, I presume. But again, that's not always the case.
I think the thing to take out of here is that we're going to have a recession. It could be in 12 months' time. It could be within 36 months' time. But it looks and sounds and feels like it's coming. It's inevitable. Whether the cause is what we're going through now or it's something else, they're scattered through history. It's part of the economic cycle. And if this is something you are truly worried about, then investing is maybe something that you need to dial down your risk exposure, or you shouldn't be in the game. But this is one of the aspects of the game. It's the rules to the game. And it's just one of those things that we're going to have to digest as it comes.
Yeah.
I just saw this at the bottom of the notes. To paraphrase Warren Buffett, the tide will have to go back a fair bit from here to see who has been swimming naked, which I think is nice, timely, and cliche with a Warren Buffett quote. But let's move on from there. We talk about inflation, and you and I talked about whether the Russians are having a bit of a giggle with the Western economies. Are we going to see $200 a barrel? And when people start wearing their jocks over their pants and putting their capes on, this is what happens. Oil falling 25%. I just want to get this chart up with crude oil prices. And it has been an absolute roller coaster for the price of oil.
Yep.
After finishing off February at a price of $95, rallied 30% and closing and over 35 on an intraday basis in just over a week. And then hitting a multi-year high just a week ago. Oil has practically done like a 180-degree round trip, and it fell 25%. And I think that was from its 52-week high to within a week or less.
Okay.
And so it's let me just clarify that. The largest decline from its 52-week high in a week or less, falling 25%.
Yeah.
And so when we're so fearful at the worst and deepest and darkest moments, this happens. like within days.
Yeah, absolutely. And you're right.
What do you think about that?
Russia were coming out saying $300 a barrel, and we've
That's
got you
right.
guys over the barrel, and it's just
No pun intended there.
completely the other way. And I mean, it's not like the potential risks to oil have dropped dramatically. I mean, unless I'm missing something, Russia still produces a lot of oil that apparently some countries are managing to get around some of the oil embargoes somehow. There's also
how are they doing that?
Yeah, I don't know.
Through China,
submarines, maybe China. But there's more and more talk about Iran getting a bit of a look in. The West all of a sudden need to find another massive oil supplier. Oh, there's Iran. But I guess it again goes to extrapolating current situations into the future and getting overexcited, pushing prices way up too high, too high, too fast. This might not be the end of it. It may spike back up again. But commodities are incredibly volatile, and I think this just speaks to that, and it's quite the ride.
And I think the point, the bottom line is history is just littered with examples of how human beings and the economy finds its way around, a rock that might fall into a riverbed. Like the water continues to kind of find its way around. And I think that's true with stuff like this, whether it's, pandemic related, people can't go to the office and people can't go to work, and, all the things that no one ever predicted that popped out as a consequence out of the pandemic. Maybe this is just one of those things where you've got a whole bunch of embargoes and sanctions, and you've got oil now doing this, and then the world's going to continue to operate in some way, shape, or form, and then we're just kind of seeing it again, and there's 25% drop in oil prices. The one that I'm bloody upset about is diesel prices, man. Have you seen diesel? It's been going absolute bonkers. I don't know why. But I've driving around yesterday and this morning, the prices at the servo have not fallen 25%. They continue to remain elevated. Let's move on to.
I wouldn't know I'm locked down, but they'll take a while. So this next chart here is just looking at bullish, bearish sentiment. So we'll bring it up here, and I'll try and explain it to you. It can be a little confusing too. Anyway, so it is the number of, or I guess, relative bulls, that is people that are positive on the market, versus the relative number of people who are less positive or negative on the market. So an indicator here you can see on the right-hand side of 38.84. So that would indicate that there are considerably more people bearish, negative on the market than there are those that are bullish or positive on the market. And we're back down to where we were in the COVID era. We'll call it the era. We're still there, but the COVID time,
people
2020,
are as bearish today as they were back in 2020.
And I guess, to some extent, it's pretty understandable. So we've got massive volatility in markets. We've got the war in Europe. We've got commodity markets just absolutely all over the place. We've got interest rates going up, inflation out of control. And, it's probably understandable that people are a little bit skittish at the moment, although unemployment is strong, which we keep mentioning. And that's usually good for sentiment. So, why
is this? Why are people... and I drive past Loon croissants or patisserie, whatever they're called, on Russell Street. Man, there is a line out the door of this patisserie. I think that's what they're called. You know what I'm talking about? Loon croissants.
Yeah. I don't.
Loon
I can't
croissants.
Go there,
they're like $50 a croissant. It's ridiculous. Man, I'm not joking, man. There is a queue out the door of at least 20 to 30 people waiting to go into this place every morning that I drive past.
Wow.
And I know this is not Australian data, it's American data, and maybe, not maybe, I know for a fact that we haven't seen food price inflation here in Australia yet. And in the US, they're seeing huge inflation in the price of food. You and I talked about this a couple of weeks ago, whereby we have very bearish consumer sentiment, yet we're breaking records on retail sales. How can people be bearish at the same time be spending all that money?
Yeah, no, you're right.
Maybe the 25 basis point rise in rates is going to make all the difference. I don't know, but to me, it just looks like some things are just not adding up right now. And whether some people want to respond to a survey because that's how they probably should feel, even though that's not how they feel, I don't know. But it seems to me that there's a bit of a disconnect here.
Yeah, and whether there's a lag effect as well. So we're hearing about inflation, and we're kind of everyone's talking about it, but we're not seeing it yet. And then when it finally starts to come through, then maybe like, oh, actually, that's when consumer spending starts to pull back, or interest rates, as you mentioned, maybe rates going up a little, kind of cools the jets of individuals out there buying. Just one last thing on this chart. So, so that there was some commentary also that 1 year later, following this sort of sub 40 type reading, the S&P 500 on average gained about 14.3%, and that was around 81% of the time. So again, that extreme negative, extreme fear. What does Warren Buffett say? Buy when everyone's fearful, and be greedy when everyone's fearful, and fearful when everyone's greedy. Quote. Yeah, it's shocking. We'll edit that out. So anyway, people are fearful at the moment, and Warren Buffett would be. But mate,
those numbers line up with the thing we talked about before. So I'm just scrolling back through the doc. Mm-hmm. Worst start of the year. That's 80% of the time. I don't know what you're looking at, but the first chart says average return of up 20%, median up 16.5%. That broadly lines up with the numbers that you've just sput out there. Yep. At 15% of the time, 15% positive, 80% of the time. So I don't know. The more that we see this, the more bullish I'm starting to get as everything starts to look pretty shitty. So I don't know. I'm 12-month bull. Maybe I'll come up with my index targets for the podcast next week. I just want to jump onto the stock market massacre that we're seeing in individual names. The stay-at-home names that just went absolutely gangbusters back during lockdown, and you had the open economy stocks and the stay-at-home stocks. Netflix produced their shareholder letter for Q4 recently, and one of the things that does get a lot of attraction from just people interested in this stuff, analysts and just avid observers and bystanders, is, I just want to bring this chart up, is their weekly global paid net ads year to date. And so it's showing their subscribers for 2018, 19, 20, and 2021. And you can start to see what they're forecasting. Have a look at what 2018, 2019 looked like. Then have a look at 2020. Isn't that just freaking insane? And look at 2020. It was actually on track to follow 2019 and 2018, literally like to the T. Mm-hmm. And then we had a pandemic. Everything shut down in March. And look what, and ta-da, surprise to everybody in hindsight, look what happened. Subscribers just went absolutely berserk. What do you think happens in 2021?
Surely it continues.
Yeah, right. Look at 2021. I bet you if you averaged out those two numbers, 2020 and 2021, my visual says that's going to be pretty smack bang on the average ads on per year on 2018 and 2019.
Yeah, I think you're spot on.
And look what's happening in 2022. We've got a forecast of Q1 of pretty subpar growth. Why do you think that is? We've had just a ridiculously high level of subscribers during that. And then you start to see the stock get absolutely crucified.
Yep.
And let me just bring the stock up now. We go from almost $700 a stock to, what is that now? My eyesight's getting poor.
357.
350.
So halved.
Is that a 50% decline in the share price?
So what? How far does this go back?
It's March of 2020. It goes back to March of 2020.
Yeah, right.
It's a 2-year chart.
I wonder, I'm just going to quickly look this up now. So pre-COVID, what do we say? 2019? It was trading at 367 a share. Right before COVID broke out, it was trading at 380 a share.
it's trading below what it was pre-pandemic.
Which is
back to where
crazy.
it was, and all those games have just been completely wiped off. The thing that I want to point out is, and you pointed this out. Let's just bring this second chart up, which I didn't even pick this up in the report. I don't know why I just overlooked it. But what Netflix go on, and let me just explain this chart. It was confusing at the beginning. It shows their forecast in the gray diamond and the actual in either red or green. If the diamond is below the gray line and it's red, it means they missed their estimates or their forecasts. If it's green, they beat their forecast. So, for example, Q1 2017, they had a forecast of 6.3 million ads by quarter versus 5.3. Q2 2017 forecast 3.7, actual 4.7.
Yeah.
And so you made a comment on this. Just touch on what your observation was.
Yeah. So look, my observation was, so of the, I think they said there were 20 quarters captured here. There were 7 that have missed, and 3 of those only by very small amounts. But my first thought was the analyst got it wrong. The management absolutely nailed it, or were conservative in a number of cases. There's one example, which is Q2 2019, where they significantly missed. But outside of that, they've been pretty much on the money or under, and under significantly. So, I think, as with always, management know what the hell's going on in the business far better than analysts do. And pretty consistently, management have.
Look at Q1 in 2020.
No, that's insane, isn't it? 7, and they actually got 15.8.
So I think that's really interesting. I want to talk about a few more that we've had a look at. DocuSign, again, the stay-at-home name that, again, was just going absolutely gangbusters. We touching $320 a stock, currently trading at $83 a stock. That's back crazy. To pre-pandemic levels.
Yep.
And these companies have got more subscribers now than they did before the pandemic.
Yep. Cash on balance sheet.
And I think it was DocuSign that came out and was saying that, or could have been Netflix, that we now need to go back. Our sales team need to go out, and we didn't have to do anything during the pandemic. We basically got a free kick. We had subscribers joining and subscribing to our, software without having had to do anything. And now we've got sales teams that have to go out and actually try and win the business, because it's not only DocuSign that was doing it. We use Adobe Sign, at our office. And then you've got all these other players coming in who are offering this type of service now. And so it's not like you're the only player offering this anymore. People are offering it at a fraction of what they're offering it at. The other one is Zoom. Have a look at Zoom, man. We're sitting at $570 a stock at the peak. And we're sitting at $106 now.
That's crazy. I mean, and you think about all the subscribers. I was reading Zoom's quarterly report recently, actually, and they were saying that, the number of clients spending more than $1 million a month has increased astronomically. And it's still growing. I mean, it's not like their subscriber numbers are declining. They're still growing, just at a much slower rate. They've got, they're now profitable. They've got tons of money on their balance sheet. It's like they were bid up too high. I think they've probably been sold down too far. Roku's another 80%.
That's an 80% on Zoom. Yeah, I put up Roku. Don't you hold that stock?
Yeah, I do. I bought it recently. I love it. I think it's a fantastic company.
I put it in there because I saw that. I'm pretty sure Matt holds Roku.
I smirked.
$475 to $114. Man, it's like 80% decline.
Yeah, look. And it's, I think it's a great business. I really do, which is why I bought it. I think I got it about 130, 140. So I'm only underwater slightly. But
don't they just make cheap the technology that goes into TVs? And
they've become a platform for TV. So let's say Sony don't bother producing their own software to house all the apps on the TV. Now Roku do it, and
but I don't think Sony used Roku.
Maybe
from
not
what
Sony,
I understand, it's like the LD brand.
No, man. Well, maybe they do, but there's plenty of like LG, There's plenty of
The
providers
LG
that
uses
do.
Roku, do they?
I think so. I don't actually know. I can't think of anyone off the top of my head, but I think it's more than just the Aldi brand, which I don't even know what brand that is, but I'll
just made it
research
up
that and I'll get back to you.
All right.
It's a buy.
Let's move on to director's cuts.
All right. So this one was interesting, and there's probably a couple of different angles to look at here, but this article kind of highlighted that or noted that Foxconn, who produce a lot of the Apple products in China, operating out of Shenzhen, have been shut down. So their entire factory, if you're not aware what's going on in China, they've basically locked down, I don't know, a whole bunch of cities, cities the size of 17 million people, completely locked them down, like Dan Andrews style. And that's resulted in a lot of factories needing to close. And Shenzhen is, I believe, one of the kind of main areas for tech production and manufacturing. So, this is a fairly major issue for Apple, just as they're releasing new phones. They're expecting massive sales this year, or certainly this quarter and next quarter. So that production is going to be hampered. We'll see how long the lockdowns last, but I think they're definitely for a week, potentially longer. But China's relentless pursuit of COVID zero cases or zero COVID cases, it's going to have knock-on effects at some point, if it's not already, to supply chains around the world. Interesting.
Because it's not problematic already.
Yeah, that's right. It doesn't take much of an issue to, much more of it to, much more supply chain issues.
Just talking about supply chain, I was just explaining to my wife about, what was going on and, petrol and whatever. We're at the market the other week and she goes, can you go get some baby corn from the Asian grocer? And so I went there was no baby corn and I got a few other things and I gave her the stuff and she goes, where's the baby corn? I said, there's no baby corn. They've sold out. She goes, is that because of Russia? I said, yes, Russia produced lots of baby corn. And because of the war, we can't get baby corn to the Chinese grocer.
So now it's the excuse if you go and forget something, supply issues.
It's supply chain. Yeah. So I want to talk about technology and with all the companies that are coming out, that are pulling out of Russia, like the baby corn manufacturers and people who put them in tins. Statista had this chart, and I'll just bring it up now. Tech companies' retreat affects millions of Russians. So my understanding is like Russians love like McDonald's, for example. That's one example of a company pulling out. So it's not just tech. Instagram, you can see here, Instagram, Facebook, TikTok, PayPal, and the list goes on of tech companies either blocking or providing limited availability, or as the Gray suggests, availability or sales that have been suspended. Smartphones, so Samsung and Apple are stopping, their sales as well of their goods. So beyond that, we've got like McDonald's, who else is Coca-Cola, Nike, who are abandoning and withdrawing out of the Russian market. And the thing I've been thinking about is, you made a comment about how much technology is being produced out of China before, and like tech hub Shenzhen being shut down, Dan Andrews style. Like, I wonder, do you think if these geopolitical issues continue and grow into, China, Taiwan, is this a blueprint for how companies are going to be dealing with sanctions? I'm curious about that, because the way I think about it is, so I was just having a look at this. Before I go on there, do you think companies will impose the same harsh sort of pathway that they've imposed on Russia to China? Because the number of McDonald's stores in Russia, 850. Do you know how many McDonald's stores are in China? Almost 4,000.
Yeah, right. Wow.
A population of 144 million people in Russia, 1.4 billion people in China. Apple has a 23% market share in China. Apple has a 15% market share in Russia. Do you think Russia is just like, yeah, okay, we get it, but it's actually not going to damage?
Yeah.
Is Apple going to pull out of China? Is Apple going to pull out of McDonald's? Is Apple going to Apple and McDonald's? Is Apple going to pull out of China? And is McDonald's going to pull out of China?
It's a good question.
Or is this like a bullshit thing that
I
companies are doing about unity around the world? And
I think it's I think it's the latter. And here's a good example.
Bullshit?
Yeah, I do. And here's a good example. So Saudi Arabia just announced the other day that they had executed 80 people for a whole range of things, and some of them
executed 80 people.
Yeah, they were pretty. Some were pretty trivial, but no one's kind of kicking up a fuss about that. Yeah, so this newfound, social justice cause that everyone's on about. There's a whole lot of things going on around the world, not just Russia and Ukraine, as bad as that is, and I'm not minimizing it, but there's a whole lot of stuff going on around the world. So if you're going to apply it to one, why don't you apply it
100%, man?
Board?
I think people are very selective in what cause. I mean, we all are, but I mean, I don't think we can be idealistic and say, well, we're going to withdraw from every country in the world because there's bad shit going on in every country. Like, I don't think you can do that. But I do believe that, people have taken a stance, and sure, it might hurt sales, but I just don't know. I just don't know whether people will apply that same concept if it was China.
Although we say that, who was the company that pulled out of China last year because they didn't want, because of the treatment of the Muslims in the northwest there? As a UK company, I can't think of who it was.
Don't know.
They copped a massive backlash.
They probably had no sales in China, so they didn't care.
But a lot of other companies are ignoring it. So no, I think it's very selective. And speaking of China, just the volatility of everything, which I know was the theme of last week. The Chinese tech shares listed in Hong Kong dropped over 6.6% at one point last week, bounced up like crazy last night. So, China's clamped down under the common prosperity mantra. Looks like maybe it's starting to reverse a little bit. I don't know what's happened there. That seems to be quite the U-turn, but we'll see what happens over the next few months around that. Jack Ma must be breathing a bit of a sigh of relief. But also China's a bit concerned, according to the media, with potentially helping Russia out and copying US sanctions. So there's so much going on here that...
and if that's the case, why isn't anyone pulling out of China?
Well, exactly right, man. Absolutely. Hey, and the last thing I just wanted to mention is Australian unemployment came out today at 4 or just a smidgen under 4. I think it was at 4%, which is back to pre-COVID lows. So,
do you reckon the RBA is going to raise this year? Just on that strong number and with whatever else is going on.
I think if they could hold out until these supply chain issues resolve themselves, which who the hell knows when that's going to be, I think they'd like to hold off. I think they probably need to have a few bullets to fire if we do start to get a bit of a slowdown. And like we said before, I don't think they can go particularly far because of the debt level. So they're in quite the bind. I bet they wish they had started to raise a little bit last year, just one or two here or there.
I think also, as it applies to the Fed, I think raising rates and then giving yourself an opportunity to cut probably makes sense. We're running out of time. Let's. What do you got for us for tips and recommendations?
Well, I wasn't prepared enough. I was going to play the theme song Bel Air is the show that I've been watching, and if you don't know anything about it, it is a remake of the 1990s absolute classic, The Fresh Prince of Bel Air, which was one of my favorite shows. Absolutely loved it.
What is this on? Netflix?
So it's on, is it Stan? I think it's on Stan.
Yeah, it's on Stan.
Which is massively overpriced for what it is. What, really? Oh, man, I'm loving it. I think it's great. Anyway,
I used to watch that too, but not.
How good was that show? So cool.
Yeah.
Anyway, so it's very different. They've taken some liberties there with some of the characters. If you love
who plays Carlton,
some bloke, but he's an angry dude. He's not happy with his plot in life.
Tyler Barnhart.
No idea. Some dude. But there's some reasonably. I think it's really good. Anyway, it's a drama. It's not a comedy. There's a lot more depth behind the story. They're hour-long episodes, I think, not the half hour for the sitcom. Right. Anyway, I like it. Quite good. I think there are only 7 episodes in the first season, of which I've watched 5. So it is one that I'll keep watching, and hopefully they come out with some more. But it's pretty good. I think Will Smith.
What do you rate it
out of
10? Will Smith got a what?
I think he's producing, or he's not producing. He's got something to do with the production of it.
Right.
And
royalties. That's what he's got to do.
Yeah,
with.
probably. Hey, do you remember the butler? Jeffrey, was it?
Yeah.
Yeah.
Jeffrey. Yeah.
Jeffrey is now a badass. Like he is like head of security, and he just takes takes care of
Is
stuff.
he head of cybersecurity as well with the new Fresh Prince of Bel-Air?
I don't know. Anyway,
what do you rate it out of 10?
Out of 10, I'm going to give it a 7.5. I quite like it. It's quite good.
Okay.
What do you got?
I don't know. I don't think I might watch that one. It sounds like you're trying to relive your youth here. I've got too many things piled up on the watch list. So we went to a Korean restaurant in town, just in Chinatown, and I reckon we've got to head down there. It was pretty damn good. It's called By Korea, and it's this little place. It's on Tattersalls Lane, just off Little Burke Street.
Yep.
Near the garbage bins and dumpsters and stuff like that. You got to, get around those. And once you get around the stink, you go into the restaurant. And it's just really cool, man. It's like really simple, street food style dishes, really small dishes, really cheap. Tons of vegan options, and so that's why we went there. And food is really flavoursome. So
yeah, right.
I would 100% go back there again. So if anyone wants Korean food and wants like vegan Korean food, the whole menu's not vegan, but they've got a whole page and section that's vegan.
Yeah, right.
But by Korea, Tattersalls Lane in Chinatown, go check it out.
Expensive, cheap? Where would you put it in the?
No, man, it's like it's street food. It's like $12 a dish, $14 a dish, just small. Yeah, they're small little dishes. So it's good for sharing and stuff like that.
Nice.
Let's wrap it up. Recording this on the 17th of March, day after Fed D-Day. We'll be back next week. Chat to you then.
All right. Cheers, guys.